Welcome to Mastering Financial Capital. Today, we're diving deep into financial capital, its importance, types, and how it's managed in businesses. Stick around for examples, FAQs, and interactive charts to solidify your learning. To begin, let's define financial capital. Financial capital refers to the resources measured in terms of money that businesses use to fund their operations, acquire assets, and invest in projects. There are primarily two types of financial capital: equity capital and debt capital. Equity capital represents ownership in the company, while debt capital refers to borrowed money that must be repaid. Equity capital comes from shareholders who invest in return for ownership shares. In contrast, debt capital is sourced from loans or bonds, requiring regular interest payments and principal repayment. Let's compare these two with an example. Suppose Company A raises $1 million through equity and another $1 million through a 5-year loan at an interest rate of 5%. Equity investors expect a return on their investments through dividends and capital gains, while for the loan, Company A must make regular interest payments. Now let's visualize how these capital types impact a company over time. Here is a projection of Company A's payments over 5 years. As we see, Company A will spend $50,000 annually on loan interest. On the other hand, equity returns depend on the company's performance and dividends, which might fluctuate each year. A critical aspect of managing financial capital is the cost of capital. The cost of equity is usually higher than debt due to higher risk. Companies often calculate their weighted average cost of capital, WACC. The WACC is calculated as follows: WACC equals E/V asterisk RE plus D/V asterisk RD asterisk 1T, where E is equity market value, D is debt market value, V is E plus D, RE is cost of equity, RD is cost of debt, and T is tax rate. For a practical example, let's say Company B has $2 million in equity and $1 million in debt. The cost of equity is 10%, the cost of debt is 5%, and the tax rate is 30%. Applying the WACC formula, we get WACC equals 2/3, asterisk 10% plus 1/3, asterisk 5% asterisk 1 to 0.3 equals 7.67%. Understanding your WACC is essential because it is the minimum return a company must earn to satisfy its investors. Companies use WACC while making decisions related to investing in projects. Next, let's discuss the pros and cons of equity and debt financing to help choose the best option. Equity financing has no obligation to repay, so it's less risky for cash flow, but it dilutes ownership. Debt financing doesn't dilute ownership, but excessive debt can lead to financial distress. For those curious about how companies decide their optimal capital structure, it's generally a mix of both. Companies aim to balance the cost and risk to maximize shareholder value. Let's see another example involving a tech startup that initially funds using equity during its high-growth phase, but later adopts debt as it stabilizes. Suppose TechStart raises $500,000 through equity initially. As it begins generating consistent revenue, it secures a $200,000 loan to finance new product development. This change showcases a strategic shift in capital structure. Now, let's field some questions from our audience. Question: what happens if a company defaults on its debt? Answer: if a company defaults, creditors can seize its assets to recover the owed amount. This could lead to bankruptcy. Question: can a company have too much equity? Answer: yes. Excessive equity can dilute current ownership and may not be the most efficient form of capital once the company is mature. Thank you for joining Mastering Financial Capital. If you have more questions or want deeper insights, leave your comments below or visit our website.